Good afternoon, everybody. Waiting for a few more people to join us. We're continuing with our theme of the unfortunate subject of insolvency, which we obviously specialize in. What we're trying to do is get a few perceptions of our view on how things are going to pan out with what will undoubtedly be an impending recession. So we're going through a few technical areas here, but what's become more and more prevalent and apparent as we go through things here is that there are a lot of moving parts that aren't definitive when it comes to especially business insolvency. So that's why we're looking to cover some of these areas. What we will say in a minute, this isn't advice. We're giving people a bit of an awareness because we've called this trading insolvently the truth, because two things. There is a lot of BS out there, generally about insolvency. Insolvency practitioners, hopefully not offending anybody, but they don't have conflicts of interest. And there are any number of barroom lawyers who know all about it. We have people come to us, we give them advice, they go off and Google it and decide they'll run with it. And unfortunately, there's a pretty high failure rate. So trading insolvently is an element of this, and that's the subject today that we're going to go through. So just a quick bit there, bit of promo, not really because it's free. We will be sending everyone who hasn't already received this an e-version of our book, which book is a big pamphlet, but it's got a couple of stuff in it. It's slightly light, this approach. There's a bit of profanity. If you're easily offended, don't look at the glossary, but it's there if you want it. And if you want a hard copy, just give us a shout here at the office. There's a couple of points of contact at the end of this. So if we crack on with the main subject, so we're looking at trading insolvently. A word and phrase banded around a lot, especially when things start to go a bit wrong. So it's very important to get the context of this, and it's quite strange because this is quite a loose subject, and that's why, again, we used the title we did. Let's try and get to the truth here. Amazing amount of subjectivity, but let's try and get there. It's a concept. It's, yes, supported by statute for those that completely abuse the system, rob the company, and leave all the creditors high and dry. Not suggesting that with Philip Green at all, but it's there. I know he's under some scrutiny now, but it's conceptual and it's not advice. You cannot give advice on an area of insolvency. You've got to look at the entirety of the case. You've got to look at behind what appears to be the problem. We were looking at a case there today, and it grows arms and legs when you look at it. When you try and get to an asset and liability statement for it, for instance, it grows arms and legs there. Trading insolvently is spoken about a lot in the last recession, and it was pretty badly used by a lot of financial institutions who didn't know any better. They learned to phrase, and they threatened quite a few people with this. It's not for a financial institution to decide if you've been trading insolvently. Let's get that right. So if ever you hear a bank think we think you're trading insolvently as part of their threatening process to try and recover funds, it's not their place to comment on that. We're going to go through the main provisions of the subject, which are pretty obvious, really. Okay, and you can go into the minutiae of the various insolvency acts to work out every provision of there in case law, da-di-da. But we're going to give a rounded view, if you like, of what's ahead of us here. Then there have been some COVID provisions, as you would expect, and I quite rudely there call them as much use as a chocolate teapot. But they need to be discussed, considered, because it depends as and when a position is or a view is taken in terms of somebody or a company trading insolvently. What is becoming more and more apparent, and that was the case prior to COVID and the lockdown, etc., not least financially, was there a lot of zombie companies literally hanging on because there's a PG kicking around. This, coupled with trading insolvently, can make a real messy situation. So we're going to give an example. It's the last thing we do in terms of this presentation of an Irish company that we helped who are hanging on, fear of the PG, and it wasn't as bad as they thought anyway. So we dealt with that. So cracking on. Trading insolvently, think about it using it back as well. Sometimes banks try to keep everybody engaged, making sure the business goes on, going on. We've used it in a couple of instances. We're going to have to stop here because we could be deemed to be trading insolvently. But banks will try and keep you going on forever and a day. Banks, etal, financial institutions, everything else. And we're going to mention briefly my sort of pet subject at the moment, the fintechs, the peer-to-peer lenders and like, who as yet I don't think as a group generally up to speed in terms of the impending damage coming from the recession that's obviously going to occur. So this is conceptual, it's not advice. Advice, we don't give advice, we give options. Someone said, well, what should I do? Well, you take the view, if I was you, I'd look at this route here. Okay, if there are any issues from here, and this element in any inquiry from what we do in these webinars is free. If you want us to look at it further and further, then we will talk if you want to take us on board. But anything in here, if there's I think out of every one, there's about 3 or 4 inquiries. It's cool, fire them in, we'll answer as best we can. And then we work from there. So as with all our webinars, strange enough, and it's very sad because of the nature of the business we're in, it's sadly interesting for us because it does show the intricacies that are involved across the board in every facet of insolvency. We have IVAs we're trying to sort out today. We met with insolvency practitioners today. And yeah, as a subject, it's not the sexiest in the world, but when you go deep into these things, there's a lot going on. There's a lot going on. And it's to be aware of these. If you are, or anybody you know is in a bit of trouble, make sure they've got the backdrop, okay, of where they are. So they, every now and then you need to pull back, take the context, go again. And that's why we're referring to it slightly conceptual. And as we say, very often financial institutions are using this as a threat and totally misplaced. But flip side, like I just mentioned, use it back. We had an instance where here in Belfast about 6 years ago, the bank were disgusted that these 2 guys could close their company down and open a new company. Totally legal, no problem at all. Their company was trading insolvently because the balance sheet was shot. We were £1 million down, and the advice was there. You could be deemed to be trading insolvently. So what we did is we got the assets value, paid for them fully, and introduced them into the new company. The money went to the bank from the assets, and then it had to be topped up in terms of personal exposure, personal guarantee exposure. But you can use it back. Don't run around going, I'm trading insolvent now, I'm closing. Make sure, again, you've got the full picture. That wasn't taken lightly, that decision, and there was a lot of work behind it, okay? Financial institutions only use it in practical terms if it suits their little argument, okay? It's something and nothing, really, in terms of what their use of it, okay? And it is the job of any appointed insolvency practitioner, not others, not banks, not peer-to-peer. Nobody else can do anything about it. They could, if they wanted to, ultimately take legal action. So heaven forbid, if Philip Green gets down the track and they get some sort of case here, big numbers involved, huge litigation, could ensue, just in case Philip's working, I don't want him to sue me. But it's the insolvency practitioner who's going to do an in-depth study of what happened to the business, and particularly look at the conduct of the directors. And if there was an element of trading insolvently, take the economic view whether that can work. We had a webinar the other week in respect of directors' loan accounts and also the increasing involvement of litigation funders. And insolvency practitioners now are well versed in finding cases that wouldn't normally have been looked at because there was lack of money in the case, now getting funded by the likes of Manolet and others who will fund such cases. So we have to be careful. We're going to do a little bit of comparison about the last recession versus this one and looking at the moving parts as to what's going on there. So insolvency practitioners, always sharp, a lot sharper in their diligence now, because if there is a case to be had and there can be costs awarded and there can be greater recovery from the creditors, there potentially is the financial support for them to follow the thing right through. So, as I said, let's have a little look back at the last recession. This isn't something we rejoice in. It's just like we want success in the economy. It's vital the economy works well. But we use our experiences, obviously, and what we do to use into this next impending recession, which obviously is happening when you lose Debenhams goes off the face of the earth, Arcadia, and all the rush from the overgeared of chains. So these are the guys that were bought by equity funds, hopped with a load of debt, and they can't get through it. And the big thing for the push for the CVAs at the minute is the change just the other day in terms of HMRC now becoming, as we were back in the midst of time, preferred creditors in any insolvency process. They've got to get paid as much as possible before any other funds filter down into the pool. So early days, but that's going to have a massive impact on CVAs. So one thing that did come from the last recession was brilliant profit. This was more based out to make some of it on the back of illegal actions by directors, etc. And he had a phrase which applies to recessions as well, because at the moment everything's going along okay. Here comes COVID. When Hardy comes to Hardy, and they start to look at the detail behind it, that's when the problems will come out. They will rise to the top. Warren Buffett's quote when referring to recessions is, "When the tide goes out, you find out who's wearing the swimwear." So we can be in great form on the surface there, swimming along, but if we haven't got the swimwear on, the tide goes out, it's awkward. We'll put it as that, right? So when the tide goes out, who's got the underwear on? Our experience in last time around will be very different to this in many ways. The economy in 12 years has evolved incredibly and is so much more complex in its structure and nature. The availability of money over the years with the quantitative easing across the world has pumped billions and billions of pounds out there. So that's created different forms of debt, going back to the fintech, any number of property platforms. We were dealing with one this morning, any number of peer-to-peer groups, specialized down to tax finance, any type of finance you want, asset finance. And very often, as I've said before on a previous webinar here, it's the toxic nature of the mix of the debt that can do for people. So that's why we were talking to a firm of insolvency practitioners this morning to try and create a model to try and deal with that as it comes down the track. Last time around, it was usually banks have gone nuts, RBS, still 72% owned by us. Just going nuts, firing the money out the door with little or no due diligence, and the asset values plummeted. Within reason, I think properties are going to hold their value. There'll be some slippage, or as Savills called it the other day, a downglide. So I think there's going to be some effect there, but materially the rise since 2008, especially in affluent areas, say in the south of England, etc., is going to be pretty awkward. So that's why I was saying it's a totally different type of recession to last time. There is money around. People are going to sit on it until they see how this pans out, but it's going to be a moving feast, if that's the right phrase, in terms of insolvency. Slightly off-piste, a couple of things there. We see the recession, but it's going to be, I think it's going to be spread out. Rishi's done his work on Sybils and Bibbles, so that's going to put into the end of this year. Going how it does hit the economies in different ways. They're all the different experts apparently are coming up with various types of recovery. Andy Haldane, who is the deputy Bank of England governor, he thinks it's going to be a V-shape. I get on Andy. Then you get the people talking about the K, in that the people with money will do well, the people without money will suffer, and that's where the redundancies will come first. We're seeing it as a bit more of a swoosh, the old Nike swoosh, and that's how we think it's going to work. That plus the complexities of the financing, back to what I referred to there as toxic mix, is going to make this a bit of a shitstorm, really, excuse the French. So that's how we see it going. As we said and mentioned earlier, insolvency practitioners, I think this time around, are going to be a lot more powerful. There's increase as long as they do hold on to the asset values. PGs, for instance, generally supported by assets and the like that will in the main hold their value, means that IPs will go for it. If they also have a drop of lit funders, and Manalet was one, it's the main one, I think at the moment, it's publicly quoted, and when the FT promotes a share, their shares have been obviously on the rise now. So you're going to get other ones out there. You're actually going to, I think you're going to get sort of similar to peer-to-peer, you're going to get other funds start coming out the woodwork here, because litigation's big costs, big fees involved. And it's how far they go down in terms of values of debts, or I don't know, but there's a lot of change going on there. So I think will be a lot more powerful. I think there'll be a lot more scrutiny on cases because it's worth insolvency practitioners' time and fees and profits. What we always say is you need to know your position. You need to look at the consequences. I mean, we're not judging anybody, but you need to look at the consequence of your actions. If you were trading insolvently but thought, I'll power through this, that may not have been the best idea. You need to look at why you did it and get your case lined up. In a minute, we'll give an example of somebody who hung on forever because of the promise of something down the track, never happened, and actually dug himself in so deep it wasn't true, and it was a pretty ugly case. But as with asset and liability statements, as with personal guarantees, get your facts together, get your stats, your financials completely together so you know where you stand. And like I say, close things off quickly. So trading insolvently, the main provision, I'm going to keep it fairly simple. That's not being patronising to who's ever watching, sorry, but it stems from the Insolvency Act over the time from 1986 onwards. So essentially, it's wrongful trading. If you're losing money and you're going to make it worse carrying on, that is the main provision of trading insolvently. This is why we mentioned that zombie company just hanging on, and then when something goes wrong, Warren Buffett's quote comes into play, you really do end up in the brown and smelly here. You've got to be very careful. So, simple terms, if you're trading, you're losing money even before COVID. Obviously, it's going to be very difficult for a lot of businesses when we get back out of this and the vaccine kicks in. Don't make it worse. Don't make it worse, because that's when the personal exposure potentially comes in. Directors have a duty to all stakeholders in their terms of their companies. Obviously, the shareholders, bankers. I do that because we're in Donegal Square here, and the main banks here. I see dear Ulster Bank across the way there. But they have a duty to creditors as well. They're taking those lines of credit to be able to run their business. You cannot make their position worse. You know, there are other provisions such as preferring creditors and like. In this instance, you've taken the goods and you've run up a bill. So what you must do is not make it worse. If you know you're not going to get out of the situation, sometimes that's a very tough decision emotionally to make, but financially, it's black and white. If you decide to plow on, say you've got a credit to your 100 grand and you get another 100 grand off them, even though you're struggling, you won't get out of it, then that's making obviously their position a lot worse, and unnecessarily so. And it may hurt your ego, your feelings, people's perception of you, but tough, that counts for nothing here, and you have to be a bit realistic. Simplest measure, we know businesses that struggle. They struggle for cash. They bounce, they can't now because there's not so many about, when they used to bounce checks and like. And the quick basic measure is your net current assets. Just simple terms, what assets can you turn into cash quite quickly? Stock, money you're owed, and what you've got in the bank versus what you owe. The revenue, the bank in a short-term basis, trade creditors and the like. That needs to be positive. So your current assets, less your current liabilities, net current assets. If it's negative and rising, be careful. There are other calculations that if it all really hit the fan, then you go and look at accounting techniques such as quick ratio and the like. That's not for this. Even if you are the simplest businessman, you know if you're struggling or not if you're a limited company. And they say this all applies to limited companies. There was a case where we had a gentleman, he was pushing like crazy under all sorts of pressure, and it was just out there, just beyond his reach, but there was a massive future contract, a massive future company, and he kept getting himself in. We kept saying, you know, there's different ways of doing this, right? But don't carry on in that same mode, because your net current liabilities, because it's a negative figure, are increasing all the time here. But I've got this great contract. Cool. When's it going to happen? Soon. Yeah. This was in February. Soon. Yeah. So's Christmas. Get on with it. It didn't happen. The company got taken down. Absolute shitstorm to unravel, because it's quite a substantial thing. It would have been great if the contract had come in, everything would have been right. But it didn't come in and never came in. So hanging on to false hopes and dawns are crazy. I'm as entrepreneurial as the next man or woman, but common sense must prevail if you're in a solvent position. It's a reality check, it's lost sleep, it's everything, it's pressure, everything, but reality must still be kept there at all times when you're making decisions, especially when you're entering this awkward period of trading insolvently. So directors' conduct is the main issue. So if directors generally, this is when you got formal liquidation, as and when directors are called to account by the insolvency practitioner, and it doesn't matter who he is. If he was introduced to you, he's your mate at the golf club, whatever, he's got a job to do. He's got to make sure you conduct yourself correctly. So first off, if you, I don't know, run up over 6 months worth of tax arrears, the revenue typically push for directors' qualification because you use their money. They're quite strict about that. And insolvency practitioners know this. If then it transpires that they could create a case that says you actually trading insolvently there from 2 years ago, and at that point you owed 100,000, say, and now you owe 300,000, that's when they might be approaching the likes of Manolet and any of the litigation funders and be saying, with a case here, we think we can get 200,000 because they're trading insolvently. That's when the personals come in. And that's what we're talking about here. It's a provision in statute to make sure we catch the bad ones, okay? If you use the corporate veil, basically, to run up debt, trade creditors and the like, rip the money out of the company, or it's basically a fraudulent action, then there should be provision for you to be able to stand a bit of scrutiny in terms of your conduct. So they will then enable the IPs, as I said there, to chase and pursue directors for any personal aspect that they perceive in respect to a company trading insolvently. That said, it's massively subjective. One, it's eye to beholder stuff. But if the accusation is made, you are guilty and you've got to prove yourself innocent. You must sort out all your affairs. And if you think this is coming and you think you have an argument, get it very strong so that when you are accused of such a thing, you're ready to take it straight back. But it is a very, very subjective area all round. And frankly, you don't hear too many cases of it. Usually they have to be bordering on fraud for them to go through, but it's still something that needs to be addressed. Under COVID-19, which hopefully now we're going to grip after the good news yesterday with the vaccine, there was a provision within the Coronavirus Act 2020. Alok Sharma, the business secretary, I think that's his title, he ensured there was a provision in there, and it was to cover basically a bit of a legal loophole. Obviously, when it all stopped, we were in lockdown. Nigh every business, if looked at in that short window, would have been trading insolvently because you were running up costs, little or no income in the main. If we take anyone down the high street there, that would be the position. And there was a 6 month window that basically said, to all intents and purposes, any position that would technically be described as trading insolvently wouldn't count in this period. That has now been taken away, that provision, at the end of September 20 by Alok, and now we're back into normal things. So it's a very small window. As I said, that we traded okay, paid our way, but many businesses, coffee shops and pubs, bless them jeepers, they obviously would have traded insolvently because they still would have had the rent, the rates, everything, da-di-da sort of thing going on. So it's now been removed. Again, a very subjective period and provision. Okay, those possibly at their work could use this element of the act that's going on here, because we're finding, in terms of litigation, there are a lot of issues when it comes to trying to take any action at all. The courts are frozen. So the subjectivity behind that is that you cannot go for a business if it was the debt was caused by basically the lockdown and COVID-19. So there's some element of subjectivity. I referred to it at the beginning there as a chocolate teapot, and it is. It means nothing. It's almost like making sure we've got a bit of cover there in terms of where we are with the insolvent trading provisions overall. Just fill the gap. Zombie companies. Now, this isn't just necessarily about in trading insolvently, but it's also covers many areas. Very often, as I said earlier, companies hang on because of the fear the director has of a PG being called into effect. And it's very hard, I put that perfect vision, right? If you have that ability to stand right back and look at really what's going on and what all the concerns are and actually take a reasoned decision, very often you wouldn't continue in terms of that trading style, should we put it, right? So but that takes some doing, pulling back and saying, right, okay, that is actually, that's crap what I've got there. That's no good. I can't go. It's very hard for entrepreneurs, as we know, to let go. It's their baby. It's, I've run it for 20 years. It doesn't matter what you run it for. If it's in trouble, it's in trouble. But we fall for it. We hang on, and we have to keep going with it. And I say, use the Warren Buffett thing again. When it stops, everything's fine. We're able to get. Anybody knows we can create cash flow out of supply. My senior partner in London used to say, cash flow is the eighth wonder of the world. And he used to say, Robert Maxwell had cash flow. It wasn't his, but he had cash flow. You consider the likes of Amazon. Jeff Bezos' approach to the thing is he ran up 10 years of loss. He didn't trade insolvently because he had loads of capital being reinvested all the time, share issues, etc. But those are slightly crazy examples. But as an entrepreneur, business owner, director, every now and again, you've got to step back and you've got to look at what's in front of you there. It's very, very important you do this, especially when the heat comes on, when you start to realize this is tightening up like crazy. Because we also find a number of directors break themselves financially trying to hang on to it. So they go from the business, trying to do everything right. They're looking after their staff, which is great, looking after their suppliers. But then they start going into their personal savings, running up credit card bills and everything else. And it still goes wrong. So it's that ability, not ability even, it's that vital requirement when it starts to hit the fan to stand back and look at it all, right? So if the company goes, my PG gets called. If the PG gets called, they're going to be after this, that, whatever. Know the, I hate the word journey. Know the journey through, right, as to where it could go. Don't depress yourself with it. Have it as an emergency file ready to go to, okay? And as I say, I think it'll be hundreds of thousands of companies are literally surviving, okay? The very rude awakening and the terrible consequences, not least the death toll in terms of COVID-19, brings everything to a screaming halt. We're still in that mode where there's nothing being done at all. We got solicitors that we know and insolvency practitioners who are doing no work when they should be very busy because the courts have afforded some protection here. But that doesn't mean it's going away. There are a lot of people hiding, right? We're busy enough, we're doing okay. But we know, unfortunately, I always add that bit to it. Unfortunately, next year is going to be very, very, very ugly, especially quarter three, quarter four. And PGs start coming into play. It's starting to look at what's really going to happen. It's very important. Trading insolvently, it's again that subjectivity, and it's having some hard facts to support in the argument. Okay, so if you're trading insolvently, again, it's got to be fairly black and white in terms of anyone looking to take litigation. If you're trying to do the best by everybody and you're paying all your creditors as best you can as you go down the track, okay, as long as it doesn't materially worsen or you're, as they use the phrase here in all nine, you're at your work and you don't deliberately worsen that situation for creditors, especially, quite hard to pin on people. And it's very important that we get that, when it stops, when things go wrong and it stops, it looks terribly harsh. Why did you do that? Why did you lend that company some money? Why did you make that investment? Why did you buy this? Why did you buy that, right? Everything comes into question. Again, it's almost like you need to be very truthful to yourself when it's coming. But really, was I trading something? I was doing my best for everybody here. There was possibly a material trade debt 2 years ago, which really hit us badly. There was a terrible supply problem. We had stuff on the high seas from China, whatever. So, but be ready to be asked why you're trading insolvently. because you were. At the end of the day, if you look at it technically, when a company goes under, there was some element of insolvent trading. The job here is to make sure you're positioned right with the information to be able to defend yourself should that accusation be made to you as a director, which then mustn't, because you need to control it, mustn't grow arms and legs that they look at litigation against you because they think you as a director personally took that route and subsequently worsened the possession of the creditors. Really long sentence there, but it's very, very important. Get all those joined up bits there, making sure you look at it. Crashes, they come along for businesses. You never see it coming. If you, the other week, I think Debenhams was going to survive somehow because JD Sports decided they fancied the look of it. And then their shareholders at JD Sports pushed back. Their share plummeted, I think, by a third or something. And then Arcadia went, who had any number of concessions in Debenhams. I don't know if you've been in Debenhams lately. Find them the dullest, inhospitable places as a retail experience. Not many good ones out there, and retail obviously has its own problems. But when it comes and you've hung on for the wrong reason, be careful. You could leave yourself terribly exposed. I'm labouring it, but it's so important to be self-reflective when you're in trouble. Not beat yourself up, sit yourself in a whiskey, see where you are. If you've hung on for the wrong reason, not cool, but you've hung on for the wrong reason, start to eradicate it. But that's what crashes do. There was no warning, obviously, of COVID-19. We as a company thought it's very slow, or if you like, the world economy was in a zombie state, save the Chinese. Don't get me started on that. In terms of, it wasn't going anywhere. There's a load of cash in the world, but it wasn't going anywhere. So that was strange. There was something amiss. In terms of 2008, that happened obviously because there was a reality check with the madness that was going on and the money that was being thrown out the door. So when crashes come, you don't usually get much notice. Here, which brings in the trading insolvently side, PG Trim down in outside Dublin there, and basically they owed the bank about €700,000, and they were under immense pressure with this, and it was very difficult. And quite rightly, their fear was the PG of 500,000, and we've just got to keep working. And the bank had their arm up their back, making them pay €2,000 a week, which is crazy in terms of what they were doing. So they were a zombie company working for the bank. They could have been an element of trading insolvently, which I'll come to in a minute, and they had a purge PG, almost like a perfect storm. We spoke to the guys, and they were very reticent at first because the PG, 100%. The PG is very, very important, but it was warping their vision, and they were just walking into a place. They had no guarantee from the bank that they would ever stop carrying on the way they were, but they were threatened regularly. So we sowed the seed with them. They're in a packaging business, and the margins were tight. And it was a struggle. Because it's 2,000 shipping off to the bank every week, they were struggling with their creditors, and it was just it was just a nightmare. They had one of the guys was ill, got himself very ill on the back of it, physically, and to a degree mentally, but it was actually physically along on the back of it. And there was a massive fear factor. They had their relatively young families, and all they could see, the personal guarantee is going to go, and we're going to lose our houses. And that goes on. Every euro was going to the bank. And I said to the guys, right, okay, you can't live your life like that. This is going to take you nigh on 6 years to get through at best, 7 years, right? That's if everything goes swimmingly, if you keep the creditors right, if you keep everything. And the buzzards were swirling. They were there. The vultures were swirling. So we explained to them an approach. And if you took the balance sheet there and you actually corrected it so that it would essentially reflect what would happen in insolvency, the company was bust. There wasn't the support for this amount of debt. So it could be construed, if something went wrong over and above that arrangement they had with the bank, that they were trading insolvently. So I said, I can tell you with total justification, hand on heart, you're trading insolvently and you need to desist because it's similar law in the Republic there. So they go, yeah, what about the guarantee? The guarantee is a different argument on a different day. So What we did is the guarantee got called upon. We were worth about 400,000 between the two of us, and we settled on about 200,000 with help from the family. They incorporated a new business, got new lines of credit, no problem, because they were good operators, and the relief for them and their family was immense. And to a lesser degree, but nearly as important, because this is the subject matter, i.e. not making creditors' position worse, creditors were pleased with the action. They didn't want to see a slow demise of a company, have to try and sort that. They had to take a hit. They worked out pricing structures that let the trade creditors that took the hit get some return as and when the business did well. But it didn't have the legacy of 700 grand of debt. The personal guarantee got a bit ugly, a couple of solicitors' letters, we're going to do this, we're going to hang you, da-be-da-be-da. Eventually you get to somebody who's half sensible, you talk to them, a bit of pushback, you should have told these, we said you should have told these clients we're trading insolvently. That thing of using it back is very important. And then eventually we got to a deal, I think it was south of 200, but it's about half of what they were worth, and it was nowhere near the 500 grand that they were torturing these people with. But the link to insolvent trading is they were trading insolvently, technically. If they'd worsened the position, they could have been personally exposed as well for that as well. So it's very important, again, going back, to keep looking at your position. If it's getting tough, take advice. Take it, not selling, take advice of people that know. Go to insolvency solicitors who know. Do the hard work, do the bit of research. This is one element of insolvency, right? They're inextricably linked, thus our existence, because we bring the whole strategy together. The key is don't listen to, if I had £1 for everyone said to me, I was talking to a man in a pub last night, right? And oh, cheapers, here we go. And then they start to spout on, he reckons, right? Okay, I said, so we're talking insolvency. What does this man do? Not slighting this profession. He's a taxi driver. I'll dead on him. I'm sure he's got it sussed. Go to an insolvency solicitor, go to somebody who can suggest, go to an accountant, go to an IP, but get concrete advice. And don't live in fear. Any of the unknown, don't live in fear. We'll give a wee bit of free advice on this specific subject, no problem, but the odd bit of advice around and about. We're not going to devise and create a whole strategy for someone who's just going to nick it and run off. We get that all the time, but get the right advice. So trading insolvently, be careful. Don't worsen the creditor's position. Be careful. Insolvency practitioners are going to have a look at companies that go wrong. So that's us. That's where we are. If you want to give us a call, you're welcome. That's my direct email address if you want to give us a shout. And there's our beautiful website. We have to say that because the marketeers are recording this and listening. They need all the praise they can get. Bless them. So that's us finished. Anything you've got to ask us, please do. And then if I don't see anybody or bump into anybody, happy Christmas and good luck. Bye now. Cheers.